Welcome back to Trading Hour. Jigar Mistry, the co-founder of Buoyant Capital, joins in now to discuss the way forward for the market. Jigar, good afternoon and thanks for joining in. It's a bit disappointing, right? Even after the 75 basis points rate hike and that announcement now out of the way, the market, forget about a relief rally, it's in fact resumed its downtrend. Are you also in the camp that believes this is a long, protracted bear market that we're looking at? Or do you think that the worst of the sell-off is behind us?
Good morning, Sonia. No, I'm not really in the camp that we are going to have a protracted bear market where prices just keep falling off. A lot has been said on your channel since the morning about what to read into this. I'll just add one point to that. That the last time when Mr. Powell was asked about whether 75 basis points is off the table or not, it was pretty much certain that it was off. And then they finally came ahead and said it and did raise by 75 bips. Yesterday, the market rejoiced the fact that it's, he didn't say 75, but said somewhere between 50 and 75, but kept adding nimble several times as a part of his interview. So I think the market itself were reading a lot more into what should be made out of it. The fact of the matter is that beyond the point, it's very difficult to say. It's not just, what has happened in the QE environment, but there is also a war-induced inflation that none of us really know of how it would, transpire as we go forward. As far as India is concerned, frankly, I think there are other challenges at hand. I think a lot of people are still not talking about the RBI balance sheet and how that has been dented with regards to what's happened in the US Treasury market as well as the domestic rate environment. And it would not be a far cry if we see repos, closer to 575 and, India 10-year at closer to 820-ish. So, whenever we do sector selections, that's something that we are keenly watching and awaiting as to what happens. The other point, which, frankly, is much more relevant to us, even more than, what happens on the rate action is where crude is. I think if we do some math, that's alarming, to say the least, because last year we were paying $75 a barrel. This year, if we take 120 average, you're talking about 6.5 lakh crores of incremental payout that India has to make to foreign countries and companies. And of that, 1 lakh crore has been in terms of lower excise, 1.5 lakh crore has been passed on. So essentially, there remains something like 3 to 4 lakh crores, which corporate profits need to absorb or pass on eventually, but passing on has not proved that easy. And the overall size of India's profitability is only 7.5 lakh crores. If you're talking of a 4 lakh crore impact because of crude, I'm not that worried about, or rather not as worried about interest rate scenario. We are already at 760-ish, maybe we go to 820, 830. But the more important pressing issue is how the crude and coal situation, resolves for India.
Hi, Jigar. Good speaking to you after a while on air. Jigar, you mentioned rejoice a couple of times out there in reaction to what Powell said, and markets reacted, but those are global markets. Nifty, our Indian markets are under pressure itself. I wanted to ask you must be managing close to around 500-600 crores, I'm guessing. What is the feedback you're getting? Are people pulling out? Are they continuing to give you all checks? What is the confidence level on ground? Because you'll be interacting with a lot of your clients.
Yes, good morning, Nigel. So you are right. See, if you look at historically speaking, essentially, we are looking at a scenario where FD rates reach 7% and the equity 1-year return is, going negative. That's when historically, from the mutual funds, people start pulling out. Now, the only memories we have of this is pre-2016. And since then, a lot has changed. Essentially your demon came in and then GST came in and the, equity markets have been very resilient. So essentially, we don't really understand as to how it will play out. You will see a 7% FD rate and a negative year-on-year equity returns maybe in the next 2-3 months. And if that sort of pulls out, then you go ahead and look at, India, which is up 30% since COVID lows, and a lot of other markets are, up to 3%. So India has been fairly resilient thanks to the money that is coming in. Our fund is no different. Frankly, we are also seeing record inflows over the last 2-3 months. And that essentially goes to the fact that, yes, this year is a problem, right? For India, all of us are aware crude is an issue, coal is an issue, and the interest rates are an issue. But essentially, if I look at a slightly longer term period, then everybody understands that the demography, the geopolitical situation, the just policy action that India has taken over the last 6-7 years is unprecedented. It's likely to see a very, very strong market going forward. So I think people are using this as much more as an opportunity to get even further positioned in. We had turned defensive. I had, I think 6 odd months back when we spoke, since August 21, we had turned defensive, and that sort of played out in our portfolios as well. But I think people are looking to increase risk in the run out over the next 2-3 months. Also, last point I would highlight, Nigel, that central banks look at inflation very, very differently. Like how we look at prices. If 100 goes to 120, that's a 20% inflation. 120 stays 120 is a 0% inflation. So inflation has fallen despite pricing remaining the same, which what we colloquially call as the base effect. And that will start playing out from September. So should we have some positives rub-offs if the Russia-Ukraine situation improves, then we are likely to see a fairly good scenario as we go around. So I think it's, when markets are down, it's fairly easy to be very, very pessimistic. I think a large amount of correction seems to have happened, and we should be very, very constructive over the next 2-3 months.
Okay, so be constructive over the next 2-3 months. That point is taken. And I think that, soothe some of the frayed nerves that we're seeing in the market now. Perhaps the worst is over. At least that's what one section of the market believes. It's a pleasure speaking with you. Thanks a lot for joining us, and have a great day. That's one opinion coming in on the market, which, by the way, is relentless now on the downside. The Nifty is now down 80 points, and it's getting worse by the minute.